Flight to safety, leading to a drop in Treasury yields, with the 2-year yield setting a course for its biggest 2-day drop since September of 2008. Okay, all of this volatility has Wall Street's fear index on steroids this week. The VIX up 39% week to date and hit a 2023 high today. So that's been another big story we're following. Let's get right to our floor show. We've got RBC's head of U.S. Bank Equity Strategy, Gerard Cassidy, and trader Keith Fitz-Gerald. And Keith, I will start with you. Your overall thoughts between the jobs report and, of course, Silicon Valley Bank and the contagion that has spread through the financial sector.
Well, what's a banking implosion and a few $1 trillion between friends, right, Cheryl? I mean, this is just everything that's wrong with the financial system all rolled into one. You've got highly leveraged stuff, Silicon Valley's arrogance being ground to a halt. You've got ricochets through the system. It's like throwing a stone in the water, only this time you got to watch the ripples.
All right. Well, that's a very interesting way to put it there. Gerard, your take?
What we've seen here is obviously something that's quite dramatic. As of Wednesday afternoon, there was no signs of any problems with Silicon Valley Bank. And here we are Friday, and the bank is insolvent. Shocking how fast this happened. But it does show very clearly that this problem that they ran into, the last time we saw it was back in the early 1980s when the Fed moved as aggressively with rates, when banks were caught on the wrong side of the trade, like Silicon Valley. So Silicon Valley was long duration on the asset side, and they funded it with hot money, variable rate money, which as soon as the first crack showed up, apparently left the bank, and that's what's caused this problem. Very unique to this bank. Most banks do not run their banks this way, especially the big banks in this country.
Well, and again, that is the story for those that are just kind of catching up on the news today. Again, as the FDIC takes them over, is the fact that they were, Keith, they were too aggressive with their bond portfolio. They're basically, and this is a classic run on the bank, but they were so focused on investing as a bank, profits for the bank, that they weren't really focused on deposits. They weren't really focused on their customers. And that is where this all seems to kind of unraveled. Also, their customers, to be clear to the audience at home here, technology startups, VC companies. Already you've got an aggressive industry and a technology industry, Keith, that's also been facing massive layoffs.
Well, exactly. And that's the point. Banking, when done correctly, should be boring. It should be like watching grass grow and paint dry. The fact that these guys went off and lost that compass is very significant. The SEC is busy regulating all kinds of things, but what it should have been done is focusing on banks like this one, because, again, this is there's going to be repercussions for a long time to come because of this. There's going to be a lot of questions asked. A lot of names are going to come out. And I think it's going to rewire Silicon Valley, which, if I'm to say anything about it, is appropriate.
All right. Yeah. And also, too, Gerard, and I was looking at your notes and your research from RBC. This is an opportunity, you say, to buy the big banks, which I think is a very interesting comment. And you say here that basically the sell-off yesterday, where you had the 4 biggest banks lose a combined market cap of $52 billion, that was Citi, JP Morgan, Wells Fargo, and B of A, you and your analysts, your colleagues say now is the time to buy. And you might maybe see some buying as we move into the end of trading today.
Actually, that's what we're seeing. It's interesting, and you pointed it out in the opening, that JP Morgan's up today. And I think what investors are finding, the dedicated bank stock investors recognize that this problem is unique to Silicon Valley. There may be 1 or 2 others, but this is not a systemic problem like 08 and 09 was. This bank was very different than the average bank. And one of the key metrics, and you touched on it, the core consumer deposits are so critical in this kind of environment. And Silicon Valley had 2.5% of their deposit mix in core consumer deposits. Your typical big bank has anywhere from 30 to 50% of deposits in this core consumer deposit area, which are very safe, very sticky, and don't run out of the bank at the first sign of stress. Very different than the Silicon Valley makeup. And that's why we think on these types of the downdraft from this problem, this is the time to buy quality names like JP Morgan Chase, Bank America, a Fifth Third, an M&T Bank, PNC, many of these banks can be purchased in this environment.
Yeah, Keith, last word to you. I do want to switch gears over to the jobs report for the month of February. We didn't get that big January revision that a lot of us were expecting, myself included. But at the same time, we did get an interesting headline, and the focus really became this morning on the wages. Wages rose 4.6% annually, below the forecast, a little bit higher from January. So it really is that wage story as we look at 504,000 jobs. That was for January, but for February, 311,000 jobs, and the unemployment rate ticking up to 3.6%. But back to that wage story. The wage story to me seems to be pushing the narrative now that we're going to get a quarter-point hike. We're not going to get a half-a-point hike at the meeting this month for the Federal Reserve. Your thoughts?
To call me skeptical would be an understatement. I think we're going to see a half because one data point does not a trend make. So I'm really leery of that. The narrative is surfacing like it is again today.
Okay. All right. You know what, Gerard? Last word for fun. One more.
Sure. I would say the final word is that, yes, this was tragic for Silicon Valley shareholders, tragic for many of their employees, but we're going to get through it. This banking system is very resilient. We have made significant changes since the financial crisis, and you know that the Federal Reserve is standing on guard. If something was to break, they will certainly step in and make sure they provide liquidity. But the system is well capitalized, plenty of liquidity, and this is an outlier. The system can handle it. We certainly don't want to see this continue, of course, but I think we'll find out a month from now when we look back that the system handled this very effectively.
Interesting. Okay, well, there we go. Final thoughts from both of you, Gerard Cassidy, Keith Fitz-Gerald. Gentlemen, thank you so much. Very busy news day. We appreciate your time on this Friday afternoon as markets approach the final 50 minutes of trading on this Friday.
Hi, it's Keith here. Thanks for checking out today's highlight clip. What'd you think? Did I make sense? Is there something you'd like to add? Make sure you leave a comment down below, and of course, click subscribe to keep up right here on YouTube, or sign up for the email newsletter at the link below. You can also find me on Twitter and Instagram for my real-time thoughts on markets, analysis, and a whole lot more.